Welcome to Roaming Returns, a podcast about generating a passive income through investing so that you don't have to wait till retirement to live your passions. In today's episode, we cover the long-awaited talk on risk and risk mitigation. We cover a few things that these so-called experts don't even bother mentioning in those articles they write. It really just boils down to a handful of things. If you can implement the strategy that we use, you'll be set. Let's roll. All right, guys, so we are back with the risk mitigation episode.
I know, excitement from everybody.
It should be exciting. We've been talking about this freaking forever.
We've been hinting at it for, I've just looked back through the emails, we've been hinting at it for months, and I'm sure we've talked about it in the podcast a few times, and we actually never just put it all together.
Yeah. So are we going to start first with, like, what actually creates risk when investing, and then go through mitigation tactics?
When you're investing, you have risk. That's just... Like
there's inherent risk, obviously.
The first thing that people have to understand is there's, no matter what you invest in, there's risk, regardless.
But our opinion, at least my opinion, I think Tim also shares my sentiment, majority of your risk, though, is self-induced through your own emotional reactivity.
Well, when we're talking about investing, there are a plethora of different things that could be risky, like the market risk, which means if the market's going down, all investments go down. If the market's going up, all investments go up. So it kind of like just like if you say you invest in Icon and then whatever the market does, that's like where the beta comes into play.
Yep.
That's that. And then the financial risk is the company can't afford to pay the bills. They'll go bankrupt. There's operational risk where the company can't produce anything. They're not like making any products.
Or economic reasons, right?
Well, that's the same thing.
Yeah. So economic reasons, like during COVID, when the climate shifted, like everybody wasn't selling things because stuff was closed. I mean, that's a risk just to keep in mind. And
there's credit risk and interest rate risk, which are kind of like
the same thing,
tied into the same area. Credit risk being that they can't afford to pay back the money they borrowed, and interest rate risks being that they're borrowing money at a higher rate, which can then lead to credit risk. So there's volatility risk, which that basically says, we've touched on that before, where like you get into something, but you can't get out of it because there's not enough volume in a day to sell it. So that's like, you have to be careful of that.
Is that actually what that one's saying? Or is that more like the beta type thing?
Volatility is this like...
Either or. It could be both.
And then geographical, political, legal, they're like things that you should know about each investment that you invest in, like where they're located. If they make, say, if they're doing oil drilling and you see that there's going to be a non-oil drilling party coming into control, then there's that political risk. And the legal risk is like a lot of utilities have this problem, like because they've been around since like before all of us were ever around it. Like they have old stuff, and like Hawaiian Electric is one, I think it's PGE, and California is another one, where like the stuff they have faults and then it causes fires or damage and then they get sued. That's like the legal risk of companies.
One of the other legal risk things that I read about was like weed stocks.
I mean, Triple M's one that has a lot of legal risk, so that one's you have to pay attention.
But like weed stocks aren't, quote, legal everywhere. So there's a thing where like if something you're investing in isn't necessarily legal in all areas, then legal could also branch into that.
So what we just mentioned is each individual investment could have any of these points of risk.
Or the market as a whole.
So you have to identify what the risk is in each thing that you're investing.
It's mainly to keep it in mind, good to know, because it's like if you're not okay with one of these, like utterly in totality, don't invest in that company.
But before you even do the research, you should do a research on yourself and determine what risk you're comfortable with to begin with.
Yes, and that's where...
We did that before. I forget what it was called, but like you determine if
investor profiles.
If you're a conservative, a moderate, or an aggressive, you have to determine what your risk tolerance level is. And once you do that, then you can identify potential investments to research and decide to buy or not. Like,
for example, we'll just touch on real quick. If you're a conservative investor, you're not going to want to invest in things that are not in the fixed income category. Like bonds are a good example of things to look at. Closed-ended funds are a good thing to look at. Preferred shares would be a good thing to look at. It's more a retention of portfolio value consideration when it comes to conservative investing. Whereas when you get towards the riskier side, you don't really care about your volatility of price or value of your portfolio. You're more concerned for the long-term picture and overall growth. And then the immediate one, moderate is the kind of a combination of the two, which I think is where we fall in.
It's where I hope to fall in.
It's our goal because we have a different approach. It's not completely long-term because we're generating income for hopefully short-term lifestyle shifting and funding. So that's why we think moderate's the best approach for what we're trying to do. So you'll have to choose that for yourself.
So see, I hope you see you have to determine what you're comfortable with. And then once you determine what you're comfortable with, then you can start determining what risks of individual investments there are. And then you can mesh those together, hopefully, and come up with a portfolio that fits your investor profile, your risk style, with investments that are less risky or more risky or moderately risky, depending on...
Or a little bit of each, so it balances things out.
At the end of this, I'll explain to you how I navigated this without actually doing any of this, because I didn't know about any of this when I put the portfolio together.
That's awesome. Intuitive risk management.
Okay.
So now we're going to cover the different strategies to minimize investing risk. Take it on, Tim.
Basically, the number one thing, if you look up a risk mitigation in Google, it's going to tell you to diversify your portfolio. And that the number one way to reduce risk is, according to the people, experts, not me, is to diversify your portfolio. I actually think we fall into the camp where we don't diversify, but we position size. But I'll get to that.
Well, that's allocation. That's allocation.
This means investing in a variety of different assets: gold, silver, oil, stocks, bonds, CDs, art, cheese, whatever. See, basically, it's the don't put all of your eggs in one basket mantra.
I think the thing that people either mess up here with diversification is that they think diversification either is buying 10 different stocks, but they might all be in the same sector.
What happens a lot is people buy ETFs or closed-ended funds, and they actually overlap. Like JEPQ and NXBG, they kind of are the same thing. We have both.
So they own the same stocks, right? In their fund.
The same stocks, and they have a similar way they generate income. So they're like basically the same thing. Like we own both, but that's us. Other people might think they have a diversification in the technology sector because they own 2 ETFs or 2 funds, and they literally cover the same thing, so you're not diversified.
Yeah, so the problem with that is awareness. We do it, we're aware of what it's going on, it's part of our strategy. If you are not aware that the 2 funds that you're invested in, thinking you're diversifying, you're not actually diversifying. So that's just something to keep in mind. I've seen other portfolios where people actually, they think they're diversified in like the energy sector because they have different utilities, but it turns out that they have the 2 different utility companies that do the same thing. Electric, so it's like if oil takes, the AT&T Verizon thing would be good. If you had like AT&T and Verizon, you're oversaturated
in the telecommunications sector.
And then when that lead thing happened, pretty much all those stocks went down. And that's that risk of diversification.
And then there's the allocation part. Like that's what I adhere to. I basically break the portfolio up that nothing's going to be more than like 5%. And that's what I try to stay to.
I think we usually land on 6%.
Well, yeah, on 6 because we have runners and stuff like that. But then that's...
Like if you've been listening to the podcast, you'll know that's actually what happened with us and Icon.
Another aspect of risk mitigation is rebalancing your portfolio to get it back down to the 5%.
So it's like it's a perfect balancing act between diversification and asset allocation because it's the percent and then the diversified component. So like with Icon, we've been talking about, if you've been listening to the podcast since inception, we were over allocated in Icon. Being over allocated when that bad news came out, our portfolio, having too many eggs in that one basket, plummeted. And then the dividend got cut, which I think is probably another one of the risk management strategies, I would assume.
No, there's like literally they only have like 6 different things.
Okay.
From everything I read, they only have 6 different things. One of them is diversification. The other one is allocation. Then there's the monitoring your portfolio rebalancing.
That to me is just allocation again.
It comes up as a different thing. Investing consistently is another way to actually mitigate risk. If you keep putting money into it, you're going to be buying high, you're going to be buying low. So like once you've actually constructed a portfolio that has a good diversification, good allocation, then you just invest consistently into those different things.
And that automatically does the dollar cost averaging, which is essentially what this is getting at. And if you have your drips turned on, that'll do the same thing. Even though we like to do like a hybrid strategy where if the value of a stock is high, we'll actually turn the drip off for that one and funnel that money then into the lower valued stocks as a way to try to keep the portfolio allocated throughout the year.
Another mitigation of risk is requiring a margin of safety. And now we've addressed that, how we do that. Margin of safety basically being if you're a value investor, you're not going to buy anything that's overvalued. And you have like a set 10%, 20%, 25%, 15%, whatever your value is that you're looking for something undervalued before you even entertain buying it.
And we pound the table on that all the time. Always buy assets when they're undervalued, not when they're overvalued.
And that's why a lot of people will actually navigate themselves without knowing it to closed-ended funds and bonds, because it's the easiest way to monitor the margin of safety, because it'll tell you right on the thing whether it's undervalued or overvalued in the closed-ended funds and bonds. If it's below 100, it's undervalued. If it's above 100, it's overvalued.
And that's why we talk about starting with those types of assets when you're new, because it's so easy to determine whether they're undervalued or overvalued. So it gives you a good training wheel setup essentially to then get comfortable and then branch into more of the other types of assets. I think a really good example of that would be, we always talk about Hercules Capital being a great company, an awesome company to invest in. But because its recent earnings smashed stuff out of the park, that company has now become overvalued.
Well, in my opinion's overvalued. I don't know yet, because they actually
by our metrics, Hercules Capital has become
it's
overvalued.
It's all-time high. So to me, that's overvalued. So I turn the drip off just to see what happens. If it keeps going up, great, awesome. If it goes down, then I'll turn the drip back on. But I have my allocation in that particular investment, so I don't really care what it does, to be honest.
But that system that we have is creating that built-in margin of safety to reduce risk, which is the whole point. And it keeps you in the game, because the more money you lose, the less money you have to invest to generate, the more you get frustrated and lose confidence, and it just becomes this vicious downward spiral.
But what I was doing the reading for this podcast, what I actually didn't read was most striking from all these experts. They all have these risk mitigation lists, how to risk management, risk mitigation, but none of them actually discuss the emotions of it. It's fascinating to me.
See, that is really interesting, because I think that's actually, in my opinion, the biggest.
Probably the top three things to have on your risk mitigation is taking the emotion out of it, just relying on numbers and metrics.
Well, that's a component of it. The other component of it is the emotions tend to creep in when you don't have your savings account set up and you don't have your emergency fund set up. Because if something then happens, say you blow a tire out, or I don't know, like you get an unforeseen
Well, to me, that's part of the diversification, is actually having a emergency fund. But
if you're looking at it from that perspective, but I don't think when you look up diversification, they talk about that component. So my point is just that if you have that set up, that system in place, it is so much easier to not have an emotional freak out session when you see your portfolio value dipping, knowing you have to tap that income, or you're going to buy a house soon, or whatever the heck your horizon is. So
that's like, in the same token, that might be why more people that are in their 50s and 60s navigate themselves to like income per like CDs and bonds and everything, so they don't have to worry about that, I guess, emotional part of investing. It's fascinating to me that no one discusses it. Like we've actually been kind of discussing it ad nauseum, but like it's super important.
Well, I think if you figure out if your fear of the value going down is because you need the money for something else, and it's showing essentially that you don't have the emergency fund set up or the other thing, that might be an easy way to nip that in the bud and not be as tweaked out. I mean, the other component you could do is literally just to what we've said several times, look at your share quantities growing and your monthly income generation growing, not the actual value of the portfolio. So sometimes it's just a tweak of perspective to get rid of that emotional component.
What I've done.
Or you could be a lovely robot like Tim.
Literally, like before I invest in anything, I don't like deliberately think about it, but I assume that it can go to zero. That's why I have my allocation of the portfolio set up the way I do, that I don't like to have more than 1 or 2 in stuff that I'm not sure about, and then I'll have like 4 or 5% in stuff that I'm pretty sure about, and then 5% in stuff I'm definitely sure about. So like if I say I invested in NEP, well, I only put like 2% of the portfolio into NEP because I'm not sure what it's going to do. It could go to zero because but I highly doubt it. It's a utility company. But like I just use that mentality that everything that I invest in can go to zero. If you think like that, then it actually helps you set up your portfolio in a way that you don't actually overextend at all.
Well, I think that goes into the psychological realm where if we set a specific expectation and the expectation is not met, that's when we're met with fear, anger, disappointment, villainization of whatever we're doing. And then it's like, you're like, I'm not doing this anymore because this didn't meet my expectations, but it's a personal expectation thing. So just like what Tim just said, if you assume an investment is potentially going to go to zero.
What's it called? Assuming the worst.
Plan for the worst, hope for the best. I love that quote.
That's how all the things I've invested in, I literally just, if it went to zero, how would this impact everything?
And that's where diversification and the allocation percent make it easy to say, hey, I don't want all my eggs in that one basket because it's possible that can go to zero. So I'm going to not put more than 5% of my portfolio or 1% of my portfolio in that company.
And then like another point that they bring up is, which I don't believe in, but whatever, it's establishing a maximum loss plan. Like at what point will you sell things? Stop losses and whatever. I guess that's a risk mitigation
So
tool.
if we spin this into our strategy.
Well, we're going to discuss what I did after we get through this boring.
Well, but I was going to say, if we spin that into our strategy, maximizing loss plan, that is more of a dividend cut thing, in my opinion. The general public, I would assume, would have that 25% stop loss nonsense they tell you to do.
Well, if you look at historically speaking, the most that the markets ever went down is 44.2% in 1931.
So you get a black swan event.
That's like the absolute worst. Like, I mean, generally, like you're probably looking at 12 to 15. So like if I was conservative and I actually believed in the stop losses, it would probably be 15 to 20% would be my stop loss. I hate them, but if I was conservative, that's what I would do. Because most of the time the markets don't really go more than 30%. So maybe even 30%. I don't know.
The problem with that approach, though, is that if it's a one-off situation, a bad news, people overreacting to a situation, you can't cherry pick. That stop loss is going to take effect no matter what happens. So to us, it's better to see what happens. And most of the time they have a rebound effect. So if your stop loss automatically goes off, you don't get the rebound.
I've seen that numerous times. Like say you're in a company that had a shitty earning report. What will happen is it'll like tank in pre-market, and then as soon as the market opens, it'll tank, and then by like 11 or 12, it'll rebound some. So if you did a stop loss, you're selling at like 9:30, but like had you waited, you could have sold, if you don't believe in the company anymore, you could have sold like 11:30 or 12 o'clock and actually cut your losses in half for the day. Generally, that's what happens when they tank. Yeah. Every now and then you get like when Icon tanked, it like literally just tanked all day. But normally what happens is it'll shoot down, it'll trigger, like I think what happens is a lot of people have their stop losses, so it'll shoot down, it'll trigger the stop losses, and then it'll shoot back up. So I don't believe in stop losses. That's where monitoring your portfolio comes in. If you don't want to monitor your portfolio, then you probably shouldn't be in individual stocks. You should be into ETFs and funds and things like that. Yeah,
that's a great mitigation strategy.
The last thing they discuss is volatile markets. You don't want to be in volatile markets, but we're in volatile market now. So
I feel like the stock market by definition is a volatile market. So that to me is just like, okay.
I think with that, like if I'm interpreting what I read correctly, like the most difficult part of volatile markets is people enter at the incorrect prices.
Buying high and selling low?
They buy high, but it's just because it's a volatile market where it's bouncing around.
That could just be another spin on the emotional component where it's like with HTGC, everybody's like, oh, this is an amazing stock. I want to get in it. It just smashed its earnings. And we're looking at it from the perspective of, hey, this is overvalued. If you're going to jump into this stock or not realizing that it's probably overvalued, and then the other savvy investors who are in it see that it's overvalued, which is going to be the hedge funds, which is going to be the bigger investors. As soon as they start dumping their shares, that's when the prices recorrect back. And the people who got greedy or FOMO essentially lose the value of the asset because they couldn't keep a curb on or do the actual research.
Well, to me, it's all about entry price, getting in when it's undervalued, because it doesn't literally doesn't matter what happens.
Like I personally think volatility is a good thing because it gives you opportunities to get in at better prices, but not everybody feels that way about volatility. That's why crypto's insane
right now.
And that's why people are so anti-crypto because the volatility component is so much more than the stock market realm. But there are certain individual stocks that are very volatile in themselves. And if you want stocks that are less volatile, you can go back and listen to our beta episode, because beta is a indicator that will mimic the stock market.
And I found that beta is usually available on every brokerage and pretty much every financial page, like CSNBC, Yahoo Finance, CNN Business. Like they all have the beta on there somewhere. You just have to know like where to look, but they all have it. It's an easy metric to identify. But
that could be a really good strategy for you if you don't like the volatility component, to help you choose your stocks more appropriately for your risk tolerance.
Okay, so that's in general what the people experts say. Air quotes.
Air quotes.
They can't hear the air quotes.
Quote unquote.
But that's what, like that. Basically, it is diversification, allocation, and stop losses, which I don't.
Not investing emotionally. That's the big one. They don't even discuss. I know they don't discuss that one, but we're adding it because it's the most relevant one, in my opinion.
Okay, so how we set up our portfolio, I'm hoping to educate you a little bit on how I did it. I determined first, like, where I want my money to be. Like, do I want it to be in REITs, BDCs, all the things that we went through, like, months ago ad nauseum to introduce you to the different areas you can invest in. LPs, regular stocks, closed-ended funds, dividend stocks, blah, 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 blah. I determined where I wanted my money. And basically, because we were trying to make a lot of money per month, it ended up in REITs and BDCs.
Okay, so I'm going to ask a question here. I'm assuming, or would you say that the different kinds of assets will change proportionately based on the economic climate from like quarter to quarter or every year or something? Something along those lines?
I don't think it'll be quarter to quarter, but like we're going to enter an economic climate where I'm going to have to do a vast overhaul of the portfolio. Once they start lowering the interest rates, some of these things are going to just pop off, and I'm going to have to determine what I'm going to do at that point. Because the REITs all in theory should go up. The BDCs all in theory should go down.
Okay, so we just talked about diversification from not putting all your eggs in the same sectors. But when economic climates shift, sometimes certain sectors...
But it seems like we are in the same sectors, but if you actually identify each of these, we're not. Like,
okay, so that was kind of what I was going to segue to.
ABR is a REIT. AG&C is a REIT.
How much of our portfolio is REITs?
MBW is a REIT. It's like 12%.
Okay, so 12% of our portfolio is REITs.
EPR is a REITs, but if you look at each of these individually, like if you looked at it as a whole, you'd be like, oh, they're invested kind of heavy in REITs. But ABR does single-family homes. AG&C, they do mortgage REITs. Completely different. Single-family homes are houses. Mortgage REITs are the debt. We went through that. EPR does the specialty stuff like movie theaters. So that's, again, completely different than single-family homes and mortgage. MPW does medical REITs. Completely different than, so our REITs are broken up into, like, we're not overlapping.
So he's diversifying by choosing REITs appropriately. But what I was essentially getting to is that we're REIT heavy because the interest rate climate, the economic climate, makes those better undervalued opportunities. So there's several different things in play.
And we're kind of heavy in BDCs because we have Trinity Capital, we have SLRC Capital, we have Main Street Capital, we have Hercules Capital. Again, Hercules Capital, they supply money to technology and certain sized companies. Main Street Capital, again, they supply money to different sized companies. Like I think it's 50 million and then one's 25 million. Trinity Capital supplies something like they all it seems like we're heavy in BDCs and REITs, but if you actually identify and look into like what their clients, it's not. We actually, what we've done is I've tried to encompass as much of the REITs as I could, the different like movie theaters, like mortgage, like houses, like industrial. Like I tried to encompass all that I could with just like 5 or 6 different REITs. I did the same thing with BDCs. I tried to get like tech companies and healthcare companies and startup venture companies, venture capitalists, whatever. Like I've tried to encompass as much as I could the many different branches of BDCs as I could with like 4 or 5 different BDCs.
Now, are you choosing BDCs and REITs just because of the undervalued component, or are you also considering the investor profile moderate consideration? Because like we said before, I think your portfolio would be a little more heavy if you were more fixed income, low risk oriented.
If you're fixed income, you do a lot of prefers, a lot of CDs, a lot of bonds.
So your portfolio would not have the level of BDCs and REITs. You'd be more invested in those closed-ended funds, preferred shares and bonds,
and
right?
CDs. You would be investing in stuff that's the money's guaranteed, basically. That's what a bond is.
So it's a combination of the two then, with the economic climate or the economic whatever and our investing strategy or our investing profile.
Yeah, well, ours is moderate. So like I have a moderate risk.
A moderate portfolio.
A moderate risk. I believe it's moderately risk. I don't like we have a bunch of utilities, which there's not a lot of risk in utilities. If I was to me, a income investing conservative portfolio should have utilities because they're not going anywhere. Now their price might fluctuate, but like their income is pretty much guaranteed because they have monopolies on wherever they're located in the country. And their dividend keeps growing. So like if their share price depreciates, so what? You're actually getting a higher dividend with more shares. I'm not conservative to me is utilities and preferred shares.
But because we actually own the conservative stuff, our strategy is more based in the metrics, which we're going to go over next week, as opposed to getting really deep and dirty into...
Because you can see how it's a moderate.
The standard definition of diversification, I think.
If you look at it, because down here is like the risky gets down here.
The risk gets down here.
Like USOI, TLSY, SLBO. Well, I'm going to go into your mom's account here so like that they can see what I think is a conservative portfolio.
And just so you know, my mom's value is like crushing. Like her growth in the last couple of weeks has been just like blowing us out of the water.
So to me, ours is a moderate portfolio. We have a lot of REITs. We have a lot of BDCs. We have a couple companies like Icon and NEP, stuff like that are, they're kind of like on the middle to upper end of risk. Her mom's account, on the other hand, has just like blue bloods. We have a couple ETFs just for giggles, but then everything else is blue blood. Like she has ABR, AFG, ALB, ARCC, BMY, BTI. Like all these companies are like, they've raised their dividend for like 12, 15, 20 years at a time. They're the blue bloods. I guess that would be like aristocrats and achievers and things of that nature. So what I did with hers, rather than, I put some money into preferreds and some money into bonds, but for the most part, I just picked up all the blue bloods. Triple M, Verizon, IIPR, HTCC.
But you did that when they had undervalued dips, right?
Oh, yeah, absolutely.
Yeah. So that's the big kicker there.
Pfizer, ExxonMobil. I mean, like, dude, her, like, it's just insane. Like, her account is so good. Like, so this is, to me, is a conservative.
The ideal conservative portfolio.
Now, what I had to do, I just didn't say, hey, I want to be in Bristol Myers Squibb. I actually waited till Bristol Myers Squibb presented the opportunity based on its PE and its PE compared to its peers that to me it was undervalued. Then of course I went in like Bristol Myers Squibb. I went in, saw that its PE was well below its peers. And then I looked at its maximum chart. I didn't look at a 1 year. I didn't look at a 5 year. I looked at its maximum chart to see like where it's been historically. And once I determined that where it's at in like the last year is an aberration to where it's historically been, I was like, okay, I feel comfortable with the PE, with the revenue growth, with the debt reduction, and where it's historically been to actually buy this. There's it's a whole different mentality when you're investing in a conservative portfolio with stocks than there is with the moderate portfolio. I didn't look at all that. I looked at some of that for our portfolio, but for your mom's, I looked at everything pretty in depth.
And the reason that we did that and have my mom in the conservative category is because she's 65 at this point. So she's going to need to be tapping this.
So she needs her principal to stay intact-ish with like the potential for growth, plus having dividends with dividend growth. So she needed like all that. Whereas we just needed income and income growth. She needs a preservation of capital, income growth.
And that's the differentiator. And that would be two separate investor profiles. And then us taking that approach, running it through what types of stocks match up with that type of criteria and the system that we go through for finding the stocks that are undervalued or the assets that are undervalued, and then buying them at the right times, allocating only specific parts of the portfolio to each one of those.
Yeah, she only has, I think, my limit on hers is, I want to say 4%. So like her allocation is everything's under 4%.
Okay. So I will tell you, if my mom had access to her portfolio, maybe we should get her on here at some point, but if she actually had access to her portfolio, she would have literally liquidated so much of it during some of these pullbacks, because she's called me, I can't even tell you how many times. And my mom's the kind of person where she thinks she sees signs everywhere. Like she does that numbers 111, 222, 444s, whatever. Do you remember that text message where she was like, I had a dream about goose eggs and something about feathers. She's like, I think this is telling me to pull my money out. And I'm just like, ooh.
So I let her do what she's going to do. And I'll be like, yeah, I'll think about it. And I never do anything because that's just ludicrous.
It was so funny. And I have to keep reassuring her that the media that she's consuming is all fear-based.
Well, that's so like if you got
Friday's email about the negativity bias.
So I did I literally went through all my emails for a week and I just positive news, negative news. And it was 75% of everything I got was the world's ending. And only 25% is, hey, there's opportunity in this sector. So then I was like, well, why the hell is it so bad?
Which we'll actually get to in another episode. But we noticed a big pattern with most of the people who pump that fear and doom and gloom crap are selling you a product to solve your problem
that only they can supply. I'm the only person that knows how to actually navigate this volatile market when it comes to utilities, or I'm the only person that knows how to navigate this volatile market when it comes to BDCs,
or crypto or whatever.
It's fascinating.
I got so many of them during that crypto winter. I was just and I can tell you that reading that actually does pull you into that grip. So I just stopped reading my emails. Because I was like, this is just...
So the way that I've actually constructed... Okay, I'm a little off topic. Okay, the way that I've actually constructed the portfolios is I use a value metric, which generally is the price to earnings, and then price to earnings versus its competitors. And then I do a historical price to earnings if I'm not sure. How to do a historical price to earnings is I just look at the 5-year PE. That's how I determine if something's undervalued. But there's another layer of risk protection. Just being undervalued is not enough. Then I look at the dividend history, the dividend growth history, if it cut the dividend. And then I look at the revenue 1 year and then 5 year. I make sure the revenue's going up. Then I make sure the debt's going down. There's a lot of different layers to the risk mitigation for investing that I use. There's a couple, the yield maxes. Obviously, I just said, YOLO on those because...
It's strategy focused. So if you set up a primo strategy for what you're trying to do and have specific assets you apply that strategy to, and you go through that same process over and over and over again, you become consistent. You do not make decisions based on emotional erraticness. Yeah. And then you start seeing your portfolio go up in value, and you start seeing your dividends go up, and you start seeing your share quantities go up, and it just... The system is where the discipline happens.
I think the discipline, you actually have to, this is my opinion, but you actually have to be balls deep into it when it's a bad market time. Like in July, when the market's tanked, or was it August? I forget. I think it was July. I think it was August. July 31st, everything looked great. And then the month of August.
It was August, September.
It was just a horrible show. I think you actually have to experience that so that you can see how your investments perform in a really crappy market.
Yes, and we talked about that in the earnings report episode, where you need to constantly reevaluate your stuff based on different market climates. And then as you go through all of them, eventually you get your strategy really dialed in, and then you can literally navigate any situation for the rest of your life.
So to me, to mitigate risk is to look at its price to earnings, to look at its dividend history, to look at its revenue history, look at its debt history. You want to look at it if you can. I know Schwab is awesome, but I don't know Vanguard's. If you have Schwab, you can look at its projected EPS growth for the next 5 years, and you can also look at its profit margins. All that stuff together is the way that I mitigate risk quite easily, actually. It's actually quite easily done once you determine what factors you're looking for in your own process. And when we go to the screener,
I was going to say, once we actually get to the screener episode next week, you'll see what Tim screens for encompasses a lot of what we're talking about in this episode. It makes sure that they're undervalued. It makes sure that
it'll make sure that they're at least valued compared to the market. Then you have to do a deep dive into the list, but I'll go through that next week.
But that's what we're going to talk about next week. He'll show you how to actually take a lot of what we're talking about today, create it into a system. So today's biggest contender, or the biggest outlier outside of the screener, is more so your matching your types of investments to your investing profile, your risk tolerance.
But you also, like, another thing that I implement that I don't know how to define it is I have kind of a crystal ball.
Yeah, that's something that I can't replicate. A lot of people are not going to be able to replicate that unless they're
like
specific personality
types. The reason that I've held on to MPW is not because MPW is a great company. It's because it's in the right sector that will be beneficial in the next few years. The reason that, say, I just picked up Newmont Mining is not because Newmont Mining itself is a great company, but it's in the right sector that I think 2 to 3 years from now is going to be banger because it's like they mine gold and silver. Like, so I got into it whenever it had a shitty earnings report and the stock went down like 12%. I was like, time to buy, because that's the contrarian. We went through it. Contrarian investing is like when everybody's selling, you seriously have to consider buying.
And at the same time, too, what he just talked about, he's actually incorporating a further vision of macro trends.
Well, that's what we just discussed, macro trends.
Because if you look back at the .com bubble, this is a prime example of this. Anything with a .com went up, even if they were the crappiest company in the world, just because they were a .com. And that same thing, what he's just talking about in the medical thing, he sees a huge change of that coming on the winds.
Well, that's why if you can find any good pharmaceutical companies that have AI, that'd be like a prime example of something.
I was going to say AI is the next one that's just going to really take off.
Something that I see like in the next 5 to 10 years, if you can find a pharmaceutical company like EXAI, we've mentioned it, they literally are going to be big in like 5 years' time.
Because they're hybridizing the medical and the AI component.
So we got that at dirt cheap, and like I'll just let it do what it's going to do.
So that's his approach on those couple of things. And again, because he has the asset allocation and diversification dialed in, he allocates a specific percent of the portfolio for these random flyers that he gets that instinct, that intuition on.
I guess. And then like another one that I really think that people should use for risk mitigation is DOGG, Snoop Dogg.
Snoop Dogg. Is it actually his thing?
No, it's just it's the dog of the DAOs. It's like
dog of the DAO.
It's the ones that performed the worst last year that have the highest yields, and they like, and then into this year they'll reallocate it to be the ones that performed the worst this year with the highest yields. Like they do all the work for you, but basically you're just betting on their blue blood companies. Like Triple M, Verizon, stuff like that. That's part of the dog of the DAO, DOGG, and they do all the work for you. Like you're basically using that. They're not going to have 2 shitty years in a row. They'll figure out whatever was wrong last year. They'll figure it out, and they won't have a shitty year this year.
And because they're doing that,
and it yields.
They put it into a fund, and the yield is incredible.
It yields 9%, 9.35 right now.
That's really awesome.
So you get 9% yield on something that's fairly conservative. I mean, that's how I do things. I don't like. It's very difficult to explain, but like that to me is a very conservative ETF. Whereas JEPQ, like, see, we have JEPQ, we have MBXG. They're basically the same thing. But we're up a ton in both of them because it's the tech, and I thought tech was going to be big, so I just loaded up on tech funds rather than individual tech stocks because. And the same thing with PDI and DSU. They're both bonds. And they're both up a lot.
So what people fail to do, I think, if they choose, it's harder to pick individual stocks from a growth perspective. That's why these funds are a lot better because it does a pool of different things in a sector. That way, whenever the leaders push out, you still acquire that growth as opposed to trying to individually pick the right ones.
I mean, the ultimate conservative play, I guess, would be to just do an index fund.
That would be the ultimate conservative, but that's not always the right approach.
Fund would be like the ultimate conservative.
And the problem with that, though, is you don't have the dividend component. So we're doing a really unique hybrid of the fund approach with the dividend thing. And what's really, really interesting is that like everything that we read about crypto and the like penny stock world, it's essentially you have to pick 10 different stocks for you to hit one that actually takes off.
Not to toot my own horn, but I told them about BitO like months ago, and BitO we're up a lot now. Holy crap.
Yeah, Tim's number's actually lower than that, so I can't replicate that because
we're up 60% in BitO.
There's that Oracle crap thing again, but
well, that makes sense. Like literally, it's literally a Bitcoin future strategy. Like Bitcoin's going up this year. We discussed it whenever we did the crystal ball of 2024 because it's halving. Bitcoin's going up, and in her mom's account, she's up I think 40% in something called ARKY, which is ARK's version of the Bitcoin Ethereum futures strategy. And she's up a ton. Like there's certain like macro trends that you have to be familiar with. That's why you have to do research. I know a lot of people don't like it. It's a dirty word, but like if you know ahead of time that 2024 is going to be a really good crypto year, then dude, buy some crypto funds.
Well, and we always talk about Tim's oracle, but honestly, the oracle essentially happens when you take in enough information that you start subconsciously noticing patterns. And that's essentially what Tim's gotten to. We've been doing all this stuff for so long, or he's been really immersed in this stuff for so long.
That's why I've been beating the table about utilities. Utilities are probably going to go down some more this year, so you have a chance to buy them undervalued, get your dividends compounding, because they'll probably go down some more this year until the interest rates start going down, and then they're going to go up. So what I'm doing is I'm planning for a year or two from now, maybe 5 months from now. Who knows when they're going to lower the interest rates, but I have a pretty conservative chunk of the portfolio in utilities, whether it be Black Hills, whether it's NEE, whether it's NEP. Like I have a lot of utility stocks in the portfolios because I know where the prices are going to go like 2 years from now at the most. So I'm just accumulating shares.
And basically, if your time horizon is less than that 2-year mark, you should not be in the stock market. You should be in Worthy. You should be in...
You can be in bullet shares.
I was going to say bullet shares might be the... If you want to be in the market, on the sidelines, making something, you can totally go into bullet shares.
Your bullet shares, if you didn't listen to that episode, you probably should. The bullet shares are quite good.
We didn't do an episode on bullet shares.
Well, there was an episode where we talked about them.
I think we should do an actual bullet share episode.
Well, that would be just short. It's like, here's the bullet shares.
That's fine.
There's like 26 of them.
Even if it's 10 minutes.
Just pick and choose. Like basically what a bullet share is they invest on a time horizon, like it'll be like 1 to 5 years, and they're investing in bonds. So they're doing all the work for you, and they pay you a monthly dividend, and the price doesn't fluctuate more than like 1% up or down.
Yeah, it's pretty sweet.
So it's like to me it's like a
stock market version.
Long-term high yield savings account.
Yeah, I was gonna say it's a stock market version of a high yield savings account, basically.
So that's where I dump like money. I don't know what I'm going to do with it, or I'm waiting on a pullback, or I have an idea but it's still too high. I'll just put it in bullet shares and just let that accumulate some shares, and then I'll just sell the bullet shares as I need the money. You're
going to hear us talking about bullet shares a lot if 2024 really does go into a bull market, because we're going to not be having the drip on once things hit the overvalue thing, because we don't want our drip to rebuy at higher prices.
Yeah, so
we're going to funnel a lot more money into bullet shares, waiting for the dips and the contrarian stuff to kick back in. So be prepared for that one. The fact that we'll be recommending going into the most conservative thing during a bull run is going to be hilarious.
We're not recommending sell stuff. We're just recommending turning the drip off so you're not buying your dividend reinvestment at a way overvalued price. Because,
like, seriously, if you go to the store and you see something priced at $100 and you go to a different store and you see it priced at $50, why would you buy the $100 one? The exact same item. So
convenience, I guess. I don't know.
Yeah.
No, like what I'm still trying to figure out. Like once I do, I'll do a podcast episode. Like, when do you sell? Yeah. Like I know when I take profits, but when do you like just sell? Like that's I guess an art form that I'm kind of okay at. I'm not great at it. Sometimes I'll sell and I should have held on a little bit longer because it went up like 10% more.
But the lucky part about that is that if you do the approach that we do and you do the research going in to mitigate the risks, you don't have to sell very often.
What I've been doing is I just take profits and then I take it like once I keep a spreadsheet where like I know exactly how much I invested in anything, and if I'm taking profits, and once I've taken my initial investment out, then I can give what happens.
And we've talked about that with the yield maxes. We've talked about that with the...
JEPQ just hit that in our account where I like took some profits and now everything in there is all profit. I don't even have to worry about what happens to JEPQ.
Oh, yeah. Speaking of yield max, we sold... Remember how we talked about selling off Coney? We sold off Coney because it greatly went up in value. So we took our entire initial investment off the table and we're just letting it ride. Well, was it Tesla?
It's NVIDIA.
So NVIDIA just... did the same thing where he came over. He's like, what should I do? This is up. He's like, but da 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 da. And I was like, well, what's our goal for the yield max? Our goal is to get our initial investment out as soon as possible. Mm-hmm. And so we took out our initial investment and we have, I think, half the shares left we initially bought. And we're just letting it compound from there because it's free money, riding, doing whatever. So your strategy applies to different kinds of stuff to reduce risk. So we took all the risk completely off the table with yield maxes, which should in theory be a higher risk.
And I've taken I've taken some of my profits in SLVO. I find it easier to just take profits and then just keep track of what you sold, what you actually initially invested. That way you can, once you hit zero, it's like, whatever, do whatever you're going to do. I don't care.
Yep. It's very, very cool. It's like once you get your house paid off or... The
problem's going to be because we're entering a bull market. So like when I'm taking profits, I'm literally just going to have to dump it into bullet shares from now on, unless there's something that's down like utility stocks, which is nice. It's nice that utility stocks are still down because I have a place to park my money now.
And that's how the portfolio allocation will get shifted a little bit during different economic climates. So it's like everything kind of is in flux. But once you understand the underlying principles of everything and the systems of everything, you can navigate and adjust your approach as climates change.
So to sum up, allocation, just come up with whatever percentage is good for you. 3%. Like what the reason you do that is to say like something that you have 3% of your money in goes to zero. Well, you're taking a 3% hit. Whereas if you had 8% of that, you'd be taking an 8% hit. So you want to allocate your portfolio to whatever's comfortable for you. To me, 5% is a good number to not have anything above that. We do have a couple above that right now. That's just because QueerTip went up a lot, Icon went up a lot, and Hercules Capital went up a lot. That's 3 of them that are above 6% in our portfolio.
So I think the general rule of thumb, if you're in something risky, 1% of the portfolio. If you're in the dividends, the good companies, the aristocrats, 5 to 6% is a good rule of thumb.
If you look at all of ours, we're like generally between 2 and 4% in everything except for a couple outliers. There's that. Then the diversification, make sure your stuff's not overlapping. Like, for example, we have MBXG and JEPQ. Literally, they're overlapping. So that means we have 2.5. And so we have 6.3% in tech ETFs. So I'm probably going to take some profits at some point to make that back below 6%.
So you can do that, or you can just incorporate it into that 6% and still invest in both. Or just
and make sure your valuation metrics are good, whether it's the PE, whether it's the PEG, whether it's historical PE, whether it's whatever your metric is for valuation. Make sure you're getting stuff undervalued. That way it's a lot less stressful. And you make sure that you have your metrics set up so that there's no emotion. And that's how I've mitigated risk and done quite well with it.
And I'm going to say it again, to mitigate a lot of the emotional risk, really get that savings account dialed in and really get that emergency fund dialed in. Wherever you pick, whatever.
That's why when we went through that, I said you should take, if you're investing, say, $100, I would put $25 into Worthy and I put $75 into the portfolio. I understand you want to grow your portfolio as quickly as possible to get your income coming in, but you also want to have the peace of mind that your emergency fund will cover any bills that you, it's like we have, I want to say $10,000, $11,000, $12,000 in Worthy.
I'd say we have probably like 20 grand total between everything in our emergency fund.
Our emergency fund is probably at least 20% of our portfolio balance. I'd like it to be 25, so I'm going to keep putting money into Worthy until I hit that. And then I have probably, I want to say 2% in bullet shares right now in Wells Fargo. So like there's bullet shares are literally just Worthy, but in the stock market. But
I do think that number is going to significantly go up as we go further into the bull market. So we'll update you on that as we go.
That's the most, I did fail to mention that, like the most important part of investing is the emergency fund, because then you have peace of mind knowing that you don't have to touch your portfolio at all.
Because the biggest risk, even though we didn't cover it and none of these experts said it, the biggest risk when it comes to investing is needing to take your money out before it's able to actually run the way it's supposed to.
Because if you think about worst case scenario in our current situation is, okay, we need money to live on the road. So we have money set aside where we can live on the road for at least a year. So I have a year to get the portfolio to do what I need to do. Like if I need to put more money into bullet shares so that we have that income coming every month, or I need to liquidate something, like I have a year to figure out what I need to do because we have a year worth of money.
And I actually have a prime example of this. So like me and my mom, when the crypto was all, off and greedy and FOMO and stuff, like we didn't do enough research and we kind of screwed ourselves in the foot. But this is a prime example of, even though we screwed the pooch from a value perspective, when our retirement accounts went down 60% of the value, I'm talking 60% drop. That's huge. We did not sell. We held on, and my mom is up 13,000?
She's up 40 grand.
My mom's up $40,000 and I'm back to break even or a little bit up, I think, at this point.
You're up by 5%. Your mom's up like 25%.
So right there is a prime example of if we would have panic sold
That's why they say that the biggest factor for wealth accumulation is length in the market.
And having a plan for your emotional reactivity. Because trust me, it was not easy to be like, oh my God, I'm down 60%.
It was easy for me because I knew how I had them set up.
And I had been in it long enough where it's like, I really do truly believe crypto is going to rebound.
Like her mom's is like 60% Bitcoin, 25% Ethereum, and then 15% altcoins. Carmela's is 50% Ethereum, 35% Bitcoin, and then 15% altcoin. So like the way I have it set up, I didn't care.
Yep. And like I said before, I looked at that money as I can't touch it in 30 years anyway.
The crystal ball that I knew Bitcoin and Ethereum were what they're going to be worth in the future.
Hopefully you guys can get to that point where you realize it's not about the value of the portfolio. It's about the longer term.
It's length in the market. That's everything that if you read any of the quote experts, the biggest contributing factor to wealth accumulation is length in the market, duration in the market. So you don't do a set it and forget it because you actually have to monitor stuff to make sure that your diversification, your allocation, and all that stuff is good. But like basically set it and forget it outside of that. But if you want
to truly set it, forget it, look at index funds and plan on working at least 30 years.
Yeah.
That's the alternative. Like it's a trade-off. You got to pick which one you want to do. And that's absolutely fine. If you realize you're the kind of person that's like, hey, I'm okay with working 30 years. I want it to be simple. I want to do index funds. That's absolutely fine. We're just giving you guys an alternative.
That's the investor profile.
If you're like us, where we're like, hell no, we want to freaking retire in a couple of years, we're done. All right, guys. Thanks so much for tuning in.
Next week will be the screener. I will walk you through like what to look for. That's actually going to be super helpful. It'll be like probably the most important of the three is going to be that one.
So these last two prepped you to get to that point, and we hope to see you next week.
Okay. I'm done with this guy.
Thanks for tuning in.